Good afternoon, everybody. It's kind of weird filming in the day, really is. I mean, it's better on my schedule, but it's also pretty weird. I'm normally making these at night, and it's kind of weird to see natural light behind me instead of the general ambient lighting of the room. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I'm back to talk about stock market and our investment strategy. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist. I'm a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. And I mean, honestly, that's mirrored in our portfolio. That's why I say that. Um, to everybody who continues to comment on the videos, thank you. I'm always down to talk finance. I'm always down to talk strategy. I'm interested to learn what you're buying, I'm interested for the rationale and why you're buying what you're buying. So by all means, please comment on the videos, like the videos, and then share the videos and help get the message out and however you want to phrase it, how to retire with dividends, how to supplement your retirement with dividends, how to retire better than the herd, how to crush retirement. But let's help more people figure out the retirement game and that there's a better, easier, cheaper, better paying, better outcome way than what's pushed through almost everywhere else. As I thought about how I wanted to go about this video in particular, how I wanted to, the stuff I wanted to talk about, the stuff that needed to be said, I, I don't like, I don't mind repeating things, but it feels monotonous on my end. And I think it feels monotonous from the standpoint of listening to the same thing over and over again. Much has changed, but the same thing, not much has changed. And I don't want to get into the habit of just repeating the same things over and over and over again. I think, I mean, and y'all know this just as well as I, the market is interesting um, in the sense of it's a very choppy market environment. You've got, without rehashing everything, we're pretty much in the same place we have been. The herd has been manipulated and is getting pushed around, or at least steered around. They're split between reinvesting into the market at large and reinvesting into technology into the market at large. And they're also getting pushed into the bond sector looking for sustainable, well, better than average, but also like realistic and sustainable dividend money because of how choppy the regular market is. And initially it was tariffs. And now it's really just any kind of ounce of doom and gloom that gets steered in the market. But what changed for us, just as the shock of tariffs shocked the herd into the sell-off, now the reality that tariffs aren't spiking inflation and the lamestream media, legacy media, mainstream media is finally having to admit that tariffs don't influence inflation. The herd is coming back into the market at large and investing. And we to the point where tariffs sent us into extreme fear. Now that tariffs are working in our favor, they're bringing people to the table to negotiate better deals between the US and pick a country. And you have President Trump and JD Vance, Marco Rubio, Scott Bessent negotiating different trade treaties throughout the world and improving trade for America, which also improves trade for you and me and helps America helps America itself get a better deal, helps Americans get better deals in the market, and then tariffs in general help uh, indirectly they help grow the economy through money the government takes in for the tariffs. So all of that's working in our favor, and people are starting to realize that it's not the it's not the doom and gloom message they got to begin with. The problem is that they're still listening to the same people. So the same people said, "Oh my gosh, the world's ending," and now the same people are saying, "Hey, it's not that bad." The biggest holdup to the economy is the Fed. The Fed is sitting on their hands or twiddling their thumbs, and you can kind of debate where those thumbs really are. Um, the Fed has been habitually, which you could like initially, it's like maybe they're just slow to react, but at this point, it's they are intentional and habitually late to the party. And I think it's all about control in their attempt to manipulate the economy. Tariffs do not spike inflation. Cutting spending, pumping more oil. Gosh, we've talked about this at length. Cutting spending all around, negotiating better trade, drilling more oil. All of those things are deflationary. Deregulation is deflationary. Lowering taxes, um, giving people more money. Just all of those things are deflationary. And you have the Fed not reacting to data. The Fed, who's been, oh no, we have to go based on the data, and then they're slow to react based on the data. So we have lowering inflation, lowering the cost of groceries, lowering gas, lowering egg prices, lowering this, lowering that, lowering this, lowering that. And the Fed's still just sitting on their hands. So that's kind of weird to me. I mean, that's not completely unexpected in the sense that the Fed slow rolls it and tries to hold on to their power and tries to manipulate and really is grasping at straws and waiting until they absolutely have to either raise or decrease rates. So with with an inflation level that continues to lower, it's really conflicting that the Fed itself is saying we can't lower rates because of why. We don't know about tariffs. We don't know if those will be inflationary or not. Tariffs aren't inflationary, and the data has shown that. We don't know if the economy is going to. We don't know what the economy is going to do. Well, we've watched the economy. The economy slowed a slight bit, but otherwise keep chugging along. Which, for all the money the Fed's been printing and pumping into the economy, and all the money Congress and USAID and all these other people have been spending, the fact that it dropped less than 0.5% is significant in the sense of that's how much money we were printing and spending, but at the same time, it didn't drop a lot. So the Fed's now cautious because they don't know about the state of the economy. Bullshit. It's about control, it's about power, it's about leverage. Don't buy their cockamamie bullshit. It's about it is about power, leverage, and control, power, and manipulation, however you want to spin those out. The Fed should have cut rates 2 months ago. They still haven't cut rates. They should cut rates because inflation is dropping like crazy and they're keeping rates high because they want power and control. And I still think we're going to see them relent. When is the best question? If you're playing the optics game, they should have relented already. We've set off a fantastic rate market for moving season at the end of a school year. It would have been fantastic for the summer, but they haven't. So if you want the maximum attention, and you got to think like a narcissist, that you got to think like an egomaniacal, all attention, all eyes on me. I want everybody's attention and appreciation. Are you going to get that over the summer when kids are out and families are distracted? Probably not. So if the Fed cuts rates over the summer, it'd be amazing. But if they really pull the egomaniacal, narcissistic way, they'll cut rates in August, maybe, or September when school's back in session and when all the adults are paying attention again. Now, it'd be great if they cut rates tomorrow. It'd be great if they cut rates at the next meeting, right? Not everybody's out for summer yet. But if we get to the end of May and they haven't cut rates, I mean, as much as I would love them to cut rates sooner, as much as they should have cut rates 2 months ago, It makes more sense if they wait till September or so, where people struggle more, and it now returns to all eyes on them. Um, so it pretty much leaves us in the same boat. You have the herd pushing back in greed cycle. It's that the herd is the fear of missing out group. Like they get easily changed by the winds. So when tariffs are bad, they pull everything out. When tariffs are okay and the economy's better, we have all these trade, we have all these peace talks and trade deals, and everything's moving in the right direction. And that pendulum swings back into greed, and they push money back into the market, looking for the quick score in the equity market or the growth sector. That doesn't need to be us. The fear of missing out mentality doesn't help us. So the herd's pushing back into the economy or into the market at large. They're also pushing into the bond market, which is good for us. Uh, you've got Jamie Dimon still signaling some type or expecting some type of recession, and I don't know if we'll hit the full out what what used to be the recession when when GDP just drops and slows. I don't know if we'll hit that. Uh, I don't know. But on the bond side of things, that still helps us. And on the Fed side of things, whenever they cut rates, it'll rate cuts will affect everything, and it'll improve a lot of things. Or really, I mean, improve. Gosh, a rate cut would be beneficial across the board, but it would really help the bond area and the bond proxy area. So real estate, utilities, energy transfer, energy in general. So whether the Fed cuts rates at the end of this month or whether they wait to cut rates in September, bonds and bond proxies are still a better place for us to be. I checked the one tech fund that I'm honestly that we own in the Roth, the one tech fund that I'm interested in picking up in our cash account or in our Fidelity account, and it's about 3 to 4% off its max. As a, its max was I think 1383. It's currently gosh, like 13.4 almost. So it's not that far off its max. And as tempting as it is, it's still, I mean, for the Roth end of things, it's a lot higher than where we bought it in at, which is great. Uh, and as tempting as the tech world is, in the sense of, I think the technology pocket of the market is just going to bleed into every other pocket of the market, and it's still going to continue to grow. I mean, you could flip a coin. Is it fear of missing out? And suddenly we have another tech blip for whatever reason, and the market drops again, or is it just going to continue to sky and and plummet at some point in the future? I don't know. But as tempting as NBXG or that tech fund is right now, the better investment is the bond and utility and the real estate markets. So if we were investing and we're not, it's just I can't explain it in the sense of like gut feeling, gut emotion. We haven't bought our next round of stocks in a while, which we I don't want a dollar cost average our buy-in just a dollar cost average and our buy-in. It's got to be, I don't even know how to explain it. If someone gave you a chunk of money and said invest this, it would be very tempting to invest all of it at once. And I would tell you to invest chunks of it over time so you get a better dollar cost average look. Uh, and then you're buying on the ups and downs of the market. That's dollar cost averaging. But it's not like you're required to invest a chunk of money every month or every whatever you like every metric unit, whether that be we'll say every month or every 2 weeks or every 8 weeks. If you hit that spot and it's like, I don't think I'm going to invest right now. It's neither like it's neither good nor bad, but at the same, it's like if are you investing because you have to, even though it's not like maybe there's just nothing currently at a great place to buy. Are you investing if you don't want to, are you investing? Like us buying tomorrow would be it's not the fear of missing out. It's also just the I can't explain it. It's like I don't I really can't. If you watch my videos before, it's like we're investing tomorrow, or I don't feel like we should be investing tomorrow, or I'm going to wait and see how the market is, or any number of things. But for whatever reason, tomorrow is we're not investing tomorrow. So I'm going to tell you some stuff I would buy if we were investing tomorrow and why. But also know on our end of things, we're not investing tomorrow. And I can't really explain that, and I'm sorry, but it's just a gut feeling. It's like when the last video, it was you had all these tariff deals over the weekend, and I wanted to look at some. I really wanted to break down some stock comparisons before we invested because I needed to do that. At the same time, I didn't want to rush and get sucked into the fear of not investing before the market spiked. And I didn't have time to look at anything. And last Monday was busier than I would want it on the school end of things. And I mean, not 30 minutes into the market being open, the market just took off. So we could have invested on the uprise of things, hoping to time it right where it's not at the peak. But that's the fear of missing out persona or mood. That's not me. That's getting sucked into the hype. That's getting sucked into following the herd and chasing whatever truffle they're chasing. And that's not me. So we didn't invest Monday, and I didn't get sucked into the fear of missing out. And we're not, for whatever reason, we're not investing anymore. I don't have a better way to explain that. It's a feeling. So this is the options list for the week. I went through and updated the closed-end fund master of all the color-coded stuff, and it's still a different look in the sense that all of these are now marked by tiny rectangles and not uh, like color-coded across, which I think I still have. Yeah, this is how I used to do it. So some of these are Roth, some of these are cash account. There's a little crossover between, but now you get to see the crossover funds better. So cash account or individual brokerage account, Roth account, funds we track in general in green, funds that come recommended by somebody I trust in purple. So of the list, every fund has a significant discount, which is the triple asterisk. These two at the bottom are great dollar cost average buys for us of what we already own. So we can sort by dividend policy. So we would get rid of the one category three. We can sort by yield. And these funds on surface pay about 8, but once you factor in their tax advantaged status, they pay around 10 for our individual uh, tax bracket. And so they would stay on the list even though they're not 9% payers. So I would sort based on the general metrics. One is at 9%, which we'll get to. But then two, does it meet what our targets are? Now, we could look at tech, but tech is expensive again, thanks to the herd pushing back into equity after the media said, hey, tariffs aren't that bad, and that changing economic status overall for the country and decrease in inflation just means that people have more money to spend. It doesn't cost as much to do business. It doesn't cost as much to do everything else. So long term, I still think bonds are great. I still think utilities are great and real estate's great. So as we use those to further sift the list, like These municipal bonds, we already have three funds. They don't really add to anything we're missing. And ERH, I'm not an all spring fan. I've said that a lot before. Saba, we own their sister fund. There used to be a huge differentiation between the two. There's not so much anymore. Saba used to be a huge holder of government bonds. Not so much right now. Realty, there's in the Cohen and Steers group, I think there's three Cohen and Steers real estate funds, and they all have pretty much the same portfolio. Now, they're structured differently in how much the portfolio is at, like what is that? Like the percentage breakdown of where they of what funds they own, but it's really just the same company. So I could advocate for picking up a Cohen and Steers fund on discount, but we already own a fund and it's in premium, and it would be like buying the same exact portfolio. So that doesn't really help. Uh, I'm not a huge consumer fan. It's got to be a different market than what it is currently for me to even think of buying a huge amount of just outright consumer funds. The fund that I track long term that I would be interested in picking up. Let's see if I scale this back, is this fund. Yes, it's consumer dominated. It's blue chip based. It used to be hidden yield in the sense that they pay quarterly or off quarterly. Um, so a true category two would be um, let's see, a true category two would be 2, 5, 8, and 11. So this one is like an alternate category two. So they're 2, 5, 8, 12. It used to be 5 cents a share on uh, at that dividend time for 2, 5, 8, and 11. Or sorry, for 2, 5, and 8. And then on 12, they would pay a special dividend that included the 5 cents plus whatever it was uh, for the year. So it used to be like 5 cents, 5 cents, 5 cents, and then $2 or whatever it was, $3. And then they've since restructured the dividend payment system and how it's divvied out. So it used to be hidden because if you looked at the yield at any one time and saw the 5 cents, you saw this really skewed yield. Like it really didn't make sense. And then they paid the majority of it at the end of the year. Now it's different. Um, it's just, I like consistent monthly income. And it's hard to consider adding something that would be a quarterly payer, regardless of what the overall graphic and company projection and company history is. I mean, overall, that fund has scaled up. The Adams Fund, I mean, if that's our graph, it starts here and it's here by the end of the year. Like it always goes up, but it's a quarterly payer. It used to have a very different dividend structure. The previous dividend structure was a hard sell, but it's also the price. Now they pay a great yield overall, but it's also the price. And currently, it's not a great deal in general. So we want to target the fund when it's around or say lower. So like it's worse than. So instead of it being 11% discount, it would be like 11 and a half, 12% discount. And it's not there right now. So let's see, consumers. So waiving consumer or waiving that category aside, that eliminates a lot. So Saba is a sister fund of BRW, similar portfolios. RLTY, sister fund of something else we own, pretty much the same portfolio. Consumer fund. The Eaton funds are a little bit different. And I can see why people would invest in the Eaton bunch instead of Calamos because of, I mean, they end up selling call options on the portfolio, so they juice the dividend. but even still not quite ready to invest in consumer products. The only tech fund or the tech fund I really like is this one, and I've shown it before. Um, there we go. So you could, there we go. So, I mean, I like this fund. It's just it's hard to commit to it in the greed cycle. Double Line is a sister fund of BSL. We already own that. Highland Floating is real estate. We get more consumer. TEEF, I've said this before, it just doesn't make sense to me. Um, it's, I mean, supposedly it's a term fund. I get that, but it's the company that their mission statement is we hate oil, but we love all these alternative energy products, which there's a place for them. But when you say you hate oil and you love all this other stuff, and all this other stuff is made from oil, that part doesn't make sense to me. Uh, it doesn't make sense to me. So yeah, can't explain it. Can't. I mean, no point explaining it beyond that. CIF we bought in the Roth, and we bought it on a roller coaster, or at least knowing there would be a roller coaster ride. FCO has the private lender capability. WDI uh, does something similar to something we already have in the portfolio with OXLC. And oh, that one's extra. Um, on my end of things, I don't like, and that's where ADX would be another um, exception to the rule is I don't like spending more than $16 on stuff or 16 a share. And the closer you get to that, it's just like if I can pick it up cheaper, why wouldn't I pick it up cheaper? Now, not every fund is the same, right? Not every fund has the same result. Not every fund has the same great management. Um, so maybe this is a great option for you. I just on my end of things, it's not. Let's see. HGLB is a sister fund to HFRO. They invest a little bit differently. I used to love this fund until it became more portfolio when it can, and that they invest in everything. It used to be predominantly bonds, real estate, utilities, energy, end of story. And that fits the current market. Like that's everything we need. And then they invested in more stuff. And diversification for diversification's sake is not my style. BRW is a bond company, but it's bonds, it's stocks, it's closed-end funds, it's precious metals, it's Bitcoin, it's a lot of different things, but it's still a bond company and it's still very pro shareholder. So the 760 is a dollar cost average on our cash account. So it would stay on this list. And PCT is bonds and it doesn't add to, like, I don't want to buy another bond portfolio simply because it's another bond portfolio. It's got to fill a need or fill a void that we don't have. So buying something, I mean, yeah, so it's priced well, pays a nice dividend, it's a monthly cycle, it's currently on a historic discount, it's close, right? 4-year-old fund, it meets the metrics, but that's diversification for diversification's sake. That's not my style. And Hicks sounds great, but and I get it, like the dividend, yeah, it's got a fat yield, but overall, it doesn't beat the benchmark. So that's the list. Now, and it's a list filtered based on yield, with the exception of the municipal bonds, which pay that tax-free or tax equivalent dividend, right, based on a tax bracket. So it doesn't meet the 9% on the surface, but it meets it on the back end. And then we have real estate, bonds with the private lending capability, and then bonds with that, I don't know, shareholder friendly company, shareholder activist company. Yeah, bond stocks, crypto, closed end funds, the works. So, would we buy everything? Well, if I'm being exceptionally picky, FCO is tempting. I mean, we own the most shares in BRW and FCO. We own 1,000 of each currently. It's tempting to keep pace in the sense of pick up 200 shares of each. FCO is pretty expensive right now compared to where we've bought it in general. And yes, this is our portfolio and it's got the dates and everything else. So, of everything else, and I'm still missing these ex dividend dates. Um, CEF Connect is generally the gold standard in closed end funds and data, but they've been lacking lately in several areas. It's still the best place to get a great overview of a specific fund. I get all the weekly updates off CEF Connect, except for the Saba funds. Once Saba started attacking, in the sense, so the Saba funds bought majority shares or bought the majority share holders in specific companies and started attacking the existing boards because they weren't shareholder friendly. Once that happened, they got dropped off the CEF Connect website mysteriously. So I get the Saba information from the Saba website. Everything else I get from CEF Connect. And you get the overall values, you get the discounts, the premiums, the dividends, when they pay dividends, the top 10 funds in a portfolio, sometimes a breakout of how they're allocated. And that's great to start. And then I'll go to Morningstar and get more info. And if I really want everything in the portfolio and a full markup of things, then I'll go to the company website. But lately, CF Connect has not had some of the dividend schedule or some of the scheduled dividends. They've not had some of the ex dividend dates. So it's kind of weird because normally it's the gold star, gold standard of closed end fund locations. Let's see. So if we're looking at, and that's life happening around me, FCO. So there's our average cost of share. You're going to buy stuff on an average as you buy things over time. So the average cost of share, like if you can lower the average cost and get a great deal, that's a great deal. Sometimes you're going to pay more than your average cost. If I look at what we've already got, 716 isn't much higher than 706, but 716 is also the highest it's been in quite a while. So I would be hesitant to buy it at its peak to see if it's going to be able to sustain that price point or if it's going to open on Monday a little bit lower. And then I would just pick it up at a lower rate or a lower price. Let's see. But outside of the one fund, BRW is a dollar cost pickup for us. So is HFRO. HFRO, we currently own 800 shares. So if we were investing, I would just even it out at 1,000. These we currently own 700 shares. Last time we bought 100 of each. I think I would keep that same idea. So at gosh, $52 total investment. Yeah. So we're still hitting an average of about 10% yield across the investment if we were investing. And I wish I could explain it better, but we're not investing tomorrow. So biggest the biggest yeah, it's so weird. I started making this video and then my wife was outside enjoying the back patio. My daughter was outside working on some stuff for school. I sat down to make this video. My daughter came inside. You had all the traffic for her coming inside. before the video started. Yeah. And then 10 minutes later, my wife comes inside from the patio. You get all the noise from that. And now that I'm about to close this video, now there's all the noise from whatever else is happening. So it's just stuff that happens in the house. It's unedited raw videos. So you get to hear everything. Uh, it's just the facts of life. On my end, it makes it much more transparent and honest and real. And I'm not in a closed studio, and nobody else is editing these videos. And it I don't like filtered, like doctor's office lit fake light videos. I hate that stuff. I like raw video, and I give you all a raw take of things. So I can't. I'm sorry, I can't put it into words of why we're not investing tomorrow. For whatever reason, it doesn't feel like the right time. Market wise, I think we're in lull is not the right word. It's and even a hold is not a right word. It's we're in this chaotic time of the market where if you are investing, you have to know your strategy and you have to be dead set on the logics of it. It's not the emotion of it. It's the logics of it. It has to make sense. You have to be able to explain it. And it's the same thing all over. Like it's the same thing every time you buy, but it's got to be true in this market because with us in a greed cycle, with the herd pushing back into the market at large and somewhat pushing back into the bond market, and the Fed twiddling their thumbs on the rate cuts and all of this other stuff going on, it's really easy to get sucked in and invest right now because everybody's investing right now. And I think you can invest right now if you have the strategy for it. If we're investing in greed cycle, we're looking at extremely specific targets in the sense of, and we are. So the bond market, bond proxies, so utilities, energy transfer, real estate. And inside of those things, we want to demand the discount. So it's got to be a great buy on the money end of things. If you're going to buy at a higher price point than your current portfolio average, that's fine, so long as you can look at it logically and it's not just a fear of missing out. Like, do I want to buy FCO now, knowing that it's not much higher? I mean, 10 cents higher is not that big of a deal, but if you pick up 20 shares, it'll be $20 higher than normal. And it's still money. Like money is money. So it's not buying it on the fear of missing out, like you think it's going to go higher. And you don't want to miss the opportunity. It's can you logically process it and reason out buying it now compared to at any other time? And the other stuff, whether bonds or utilities or real estate, it's you have to demand a discount. I mean, in general, we demand the discount. But when the market is in greed territory, regardless of what you're buying, we want to demand the discount so we get the absolute best deal possible in any market, right? Because we could hit, who knows, we could hit a year greed cycle. I mean, that would be weird, right? No chop, no anything, just a slow climb, just pedal to the metal, right? Like that'd be like a diesel, but pedal to the metal. And then once we hit going, we just take off and we just stay in greed. There is still stuff to buy in greed territory because as the herd pushes one way, that's going to reveal pockets and opportunities in a different path. And that's where you have to be confident of your strategy so you don't get sucked into that tailwind or sucked into however you want to, sucked into everything the herd is getting into. And it's like the fear of missing out, I'm going to buy late. It's when everybody else is looking one way, what opportunity awaits us looking in a different direction? And of those opportunities, which presents the best long-term viable plan, right? If you had a list of 5 funds that were all downtrodden, you get to get them dirt cheap. They paid a fat dividend. You get them on a steep discount, which on my end, that's still HFRO. Like you get it super cheap. You get it with a decent dividend, but also with a dividend that could rise. You get it at a super super cheap amount because its discount is almost 60% off. And it's in a field where if the rate, and it's all if, right? But we don't want to completely subject ourselves to chance. It's not that I'm picking a pipe dream or a fart in the wind. It's not that. It's what can I logically pick that has the best overall projected outcome, even if nobody else is doing it. And that's the risk of the market. It is a roll of the dice. It is how you as a person see things going, and how you have to kind of project the herd and the market at large and everything else going. It's like catching fish. We teach people to fish. We don't teach people to catch, right? We go hunting and not shooting, right? If it was an obvious game, if it was like shooting fish in a barrel, everybody could do it and everybody would be great at it because it's shooting fish in a barrel, but it's not. You have to do the best thing possible in this market with knowledge of the long-term market, or at least knowledge of the overall projection or overall trajectory of the market. So in this current market, with inflation dropping, with us cutting spending, with us making it easier on consumers and better for consumers, drilling more oil, drilling more natural gas, with us creating an economy that's set to thrive, and a Fed who's content to sit on their thumbs and wait for any number of reasons, really doesn't matter what. In this market with high rates that don't make sense, right? With inflation dropping and rates high, that doesn't make sense. Sounds like the Fed's not doing their job. They're not. In this market, what's the best possible outlook for us long term? You could argue for anything, but then you haven't factored in the herd. The herd is pushing back into everything. They're pushing back into equity and growth because they see that themselves. They see the market about to take off. It's just they don't know where to go. So they go where they know to go, which isn't really helping them. And on our end of things, we see the market differently. We see investing differently. We see a bigger picture, and we don't follow the herd and we don't step in their ship. So on our end of things, it's bonds, utilities, and real estate. Because if the Fed cuts rates, or at this point, it's when they cut rates, or when they get off their hands or get off their asses and cut rates. But when they cut rates, everything will do better. But bonds and utilities and real estate will do amazing. And at that point, when the market shifts again, then we look and see what else is there. Like, we want to get into those things early, and we have been. When the Fed cuts rates and everybody jumps on board, which is what we want, then there will be opportunities behind that. While everybody, same thing, while the herd and most people look one way, we have to be aware to stop and look the other way and see what the next best deal is for us, because it's optimizing your investments. It's buy what's best now for the long-term game. So think of your strategy, think of how that impacts you, invest logically, invest without emotion. You can invest no, like, it's the fear of investing, right? It's I think my heart rate goes up every time I invest money. It's That's normal. You want to avoid the fear of missing out and avoid the fear of I'm going to miss the boat, right? You don't want to get sucked into that. So know your strategy, invest with logic, take as much emotion as you can out of it. If you're ever at a point where you're unafraid to invest, I would say you need to stop and rethink things. Um, but other than that, I mean, you really do. You have to sit down and be comfortable with either investing tomorrow or not investing tomorrow. And for us, we're not investing tomorrow. So we'll see what the week brings. Maybe that changes midweek. Maybe that changes next week. I don't know. We'll see. Uh, on my end of things, I'm about to have more time, which is a very good thing. Um, About to get a much needed break from the school year. About to have some much needed time to make some more videos. I know I need to post a strategy video. I know I need to post a closed end fund video. Uh, I know I need to make a portfolio video. And then wrapped into all of that would be if I could summarize it like a market where we would look for other things than bonds. And part of that would be the rate cut and how the herd responds. My, you know what assuming gets. My hope would be the Fed cuts rates and it pushes the herd. I still think the herd would push itself into equity and growth, but I would hope they would push into bonds because it's a for sure fat dividend payment. Um, but even if they don't, it's still, I mean, it's the weird, it's not a coin flip. Whether the herd invests in bonds or not, bonds are a great place for us for everything I've already said. If the herd finds bonds or finds closed-end funds and realizes how good they are compared to the regular market, that's still a good thing for us. So if they buy more shares, they decrease the discount window, share value goes up, and then you get to look at is that the end of a cycle and it's time to cash out and sell and buy something else while the herd's feasting on bonds? Or is it time to hold out and see where the market goes? Well, I mean, together we'll see. So, my advice to you for the week, and really in general, figure out your strategy. Don't be afraid to invest in greed. But if you are investing in the greed cycle, know why and know your targets and invest invest logically and without emotion. In the sense of you want to invest you want to invest according to your strategy and not simply to miss out on the current opportunity. So that's all I got. Whatever you have for the week, I hope it goes well. I'm looking forward to the end of this week and the end of the school year, and I will finally be able to uh, give myself more time to think about business, more time to think about our businesses, and then more time to think about making those other videos. So whatever you have for the week, I hope it goes well, and I will see y'all on another video. Bye-bye.